One special meeting, a regular meeting of the West Hartford Pension Board. My name is Nancy Dean and I am chairman of the board. Because in-person attendance at public meetings is likely to increase the risk of transmission of COVID-19, this meeting is being conducted in accordance with Governor Lamont's Executive Order Number 7B, which permits municipalities to conduct public meetings virtually. Members of the board and some town staff are participating by WebEx, and members of the public can view the meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV Channel 6098 or at www.hctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town's website. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I ask all participants to please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see hands go up. If you are participating via audio only or I do not call on you and the debate is ending, then please unmute your phone and let me know so that I can recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, and approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion just by unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time that they speak. Fourth, because of the difficulty in tallying voice votes on a video conference, I will require that all votes be taken by roll, and Lori Carney will continue to assist me in that regard. Fifth, a reminder that if any participant has a problem with their connection, you should immediately call Lori, whose phone number you have all on your Rolodex, all in your phones, I'm sure. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting and participate by audio only. As I mentioned a couple of minutes ago, I think this is our final WebEx meeting. All things staying stable with the health here in Connecticut. So next time, perhaps we will be in person. And with that, I will ask Lori to call the roll.
Okay, thanks, Nancy. Nancy Dean.
Here.
Lazaro Guzman.
Present.
Alan Lebo.
Here.
Ethan Goldman. Are you muted, Ethan? Okay. Brittany Birmingham.
Here.
And Peter Privatera.
Here.
Mayor Cantor is not attending. Matt Hart. Chris Kashmar.
Here.
Rick Ledwith.
Here.
Lee Gold. I didn't see Lee at all. Okay. Paula Kanaki.
Here.
Jennifer Evans set up the recording. And is it Leon Davidoff attending as well?
Yes, I'm attending for Sherry Cantor.
Okay, thank you. Is there anyone who is participating whose name I have not called? Okay, Nancy, all set.
Okay, thank you. Good morning once again to all. This is Nancy Dean speaking. We do have a full agenda this morning with some very important things to accomplish. I did want to give you all an update on something else that's been being worked on since our last meeting. The Corporation Counsel's Office has been coordinating the review of and issued an RFQ to evaluate our current legal counsel. I think they're doing this throughout many of the contracts that they have for the town, but in particular, I think you all know that Reed and Riga has been counsel to the pension board or the pension function for many, many years, probably over 20. So they've been in that process. They did issue an RFQ Rick, Peter, and I were invited to attend of the results that they got. There were 4 firms that they invited back. As I said, Pete, Rick, and I were invited to attend those presentations virtually. Some of the firms presented better than others in their oral presentations and written response. The Office of Corporation Counsel intends to follow up with a few items of specific interest to the RFQ request and expects to finalize the selection of the firm by the end of May. So I just wanted to give you an update on that. We don't typically see them here. We do see that the HR folks, Rick and Lori, will have communicated with them from time to time for clarifications, but I just wanted to let you all know that that was something that would be being visited in the next month or so. So with that, I will turn the meeting over to Peter.
Good morning, everyone. Just have a couple of items. The first item, we are, it appears we're going to be lowering our issuance amount to about $325 million instead of $360 million. We asked the actuary, we asked Becky Seelman to go back and take another look at our assets since the last full valuation was performed. And she came back and with some good news regarding asset performance of the fund. And it appears that we only need to issue $325 million and still be at 100% funded as of July 1st. So that's going to save the town, some significant funding related to the pension obligation bond debt service. Some more good news. Chris Cashmere and I, and to some extent Nancy, but Chris and I were having discussions with Wells Fargo on the fee related to this significant influx of cash into the trust. And Joseph DePalma, the account rep, came back and agreed to cut their fees in half. So it is an asset-based allocation model. I think we're paying 1.1 basis points. Now it's cut down to 0.55 basis points. So we're not going to see an increase in that fee as well. Also, I've been working with Bill Lindsay, our financial advisor, on an issuance calendar. It appears that we have it all set. Right now, we are out to RFP on potential underwriters. This is going to be a negotiated sale, and we'll probably select 2, maybe 3 underwriters. We have a tentative sale date of mid-June, and hopefully close the first week of July. So everything is in motion and is moving according to the timetable that we had established a while ago. Just had some additional good news regarding the amount of debt we're going to issue and the cost of the trust costs from Wells Fargo. So that's those are the updates I have. Thank you.
Thanks, Pete. And in that regard, I know our next regularly scheduled meeting is in September. I think we may want to, as it gets there in that end of June, early July timeframe, just as the funds, the proceeds of the issuance will be in the town's account, that we may want to reconvene one more time just with that single focus meeting. So we'll keep you posted in that regard. Other than that, Chris, I will turn the floor over to you.
Great. Thank you, Madam Chair. Good morning, everyone. If it pleases the group, maybe I'll pull up the screen, the report, if that's okay. And we'll, so you can folks see that okay?
Yep, looks good.
Yeah.
Great. Okay, so we'll use, again, good morning, folks, and we'll use select pages from the attached here. I think really we have, per the agenda, 3 topics of discussion this morning. We certainly want to catch you up formally with performance of the fund through the end of the first quarter, calendar quarter, March. We did have an issue that we've periodically addressed with the board in the past that relates to peer and their fee construct, and just wanted to catch you up on that. And I'd gather the perspective of the full board in this setting. And then finally, we'll continue to pick away. I know we've talked a couple of times about dollar cost averaging particulars, right? And how those funds may be invested alongside the existing assets as you kind of work through the dollar cost averaging schedule. As the chair mentioned there, we'll likely have an opportunity to tackle that once again when the bond deal is completed. So with that here, I'm going to, bear with me here, let's see, just quickly bring you through a couple of details. This quarter, just in terms of a governance overview, is a pretty quick hit. It's just fees. Quickly, we did recatalog some of the actuarial information, but this schedule up on the screen is the one of greatest interest this quarter. So we do want to periodically, as a group, have a formal accounting for the kind of the recurring fees, if you will, related to investing the assets here. And you see via this exhibit that obviously, as you would expect, right, the heavy lift comes from the collection of managers and their fees. So on a weighted average basis there, you see in the middle of the exhibit today, based on current allocations, the plan bears, the fund bears about 33 basis points, 1/3 of 1% of investment expense. Peter made reference to the accounting or custody fees, rather, which are going to go down a little bit. We have a flat fee. I think if you do the arithmetic on all that today, right, you're somewheres on the order of 36 basis points all in. We know that there are other ancillary fees related to administering the plan, but in terms of kind of the recurring, if you will, investment related fees directly, we would submit to the board, just for the record, that 36 basis points we think is a pretty competitive all-in fee, and it is certainly competitive with what we see for similar sized plans that we work with around the region, for example. So again, not an action item for the board, just kind of reporting that detail in, and we'll do that again, right, year over year as part of the governance effort. I don't know if any questions on that from anyone. Pretty straightforward, I think, but there's an...
Alan has a question for you.
Okay, sure, Al.
Nancy, if you want to recognize. Okay, so this is Al Lebo. I'm a board member. I was just curious as to how you handled, on this fee schedule, how you handled the ones that they get a fee, but they get a bonus if, you know, things are handled properly. How are they scored on here?
Yeah, I think you're thinking about for peer, for example, Alan?
Yeah.
Yeah, so we'll when we get to that section, we'll talk about that. Honestly, in this schedule, you can see there we're using just their base recurring fee, the 40 basis points. So you're right, arithmetically, there's probably a couple more basis points there floating around. We'll talk to that. Good point when we get to the peer analysis, if that's okay. So in practical sense, it might lean a slight higher than the recurring 36 basis points to account for that.
They are, this is Nancy speaking, they are the only one that is on a pure basis point schedule. We've visited this every couple of years, but I had asked Chris to do a special review of that. So that's actually very next on our agenda once we finish the quarterly review. Okay, Chris, why don't you continue?
All right, we'll forge ahead here and quickly just catch up. I think this group I know is particularly attuned to market activity and the like, but just to level set for a minute or two, kind of refresh what's been going on in the markets. I think, as everyone knows, and we'll see momentarily and ratify this, right, the last year in the capital markets ending in March, and even largely continuing through this morning, honestly, has been pretty darn remarkable, right, in terms of the appetite for risk. And that appetite for risk has come since the onset of the pandemic or shortly thereafter from certainly the stimulus efforts that have been now well cataloged, both on the fiscal and monetary front. And we are over here, just as we come into the spring of this year, as you all know now in Washington, we have had most recently, the Rescue Plan Act, which has a pretty particular and heavy focus on the consumer, as you see in the upper right-hand corner of the page, in terms of the constituent parts of the act. That's important, of course, right? Because obviously consumers are 70% of economic activity in the country, and to the extent that there's a bridge there for them to relief and whatnot, as the economy kind of continues to work through its transitions. That's important. It's talks of infrastructure spend, talks of other acts potentially forthcoming. The authorities, both the Fed and Washington, right, have been pretty adamant that this will stay kind of in play in terms of stimulus and until we're kind of fully recovered. And investors, as you know, have certainly taken comfort in that. It has meant a bit of pressure recently on interest rates and inflation expectations, as you see indicated in the lower left-hand corner of the page. Kind of both things in our estimation, right, that are consistent with an economy that's poised to begin to self-sustain and generate more consistent growth and the like. Those are pretty common occurrences early cycle. So we don't view them, while they're noteworthy, we don't view them as problematic or challenging ultimately the path that the recovery takes. But something to be mindful of. And then the other thing really under the hood there, we talked about this, I think, in a couple of our immediately previous meetings. You see in the lower right-hand corner of the page of interest from an investor perspective in our mind is this idea that breadth, capital market return patterns, their breadth has expanded out pretty significantly. So you'll see there in the lower right-hand corner, if you can make it out, we kind of cataloged up until beginning of last November and post that date is when you really saw a turn away from just the large cap growth names in the U.S. that had done so well early on in the recovery, to see a much better participation from international stocks and value stocks and smaller cap names. And that's largely continued over the last several weeks as well. And again, another encouraging sign to us, because that is historically the type of patterns that foreshadow more consistent economic activity in that next cycle. So the backdrop remains an accommodative one for risk taking, for sure. We won't spend a ton of time here, but you'll see in the upper left-hand corner just a couple of statistics we found of interest: unemployment rate patterns and moreover participation rates. We did see generally pretty big improvements on those fronts. As you probably saw last week, we actually had a little bit of a step back in terms of the progress on the unemployment front. Probably not entirely unexpected, right? And I don't think any of us anticipates a full stepwise consistent pattern to recovery. There's lots of repairs that still need to be made in the economy. And we saw a little bit of that last week in terms of some softness. Moreover, it kind of speaks to this idea, right? For example, that the Fed has mentioned that we kind of anticipate this, and it's the motivation for keeping our stimulative programs in place. And then I'll leave you on this page in the upper right-hand corner, just you do see the step back in GDP growth generally around the world in 2020, and then moreover, as you would expect on a consensus basis, right, a much more consistent pattern of growth across the world as, again, things begin to repair. And kind of investors, of course, have been encouraged by that as well. So that is the last thing maybe on this page actually is worthwhile. I would turn your attention, while it was a solid quarter, as we'll see in capital markets generally, the one-year numbers, I think this is the column perhaps that's the most just, stupendous, right? And I would turn your particular attention here, if you can make it out, to the equity markets around the world and just the sheer absolute magnitude of return. 56% in the S&P 500 for the 1 year through March, and really across the balance of the equity opportunity set globally. There you see some pretty amazing numbers. Fixed income is generally held up pretty well also. We'll see momentarily some of the details there. much more nominal returns, right, as rates have grinded a little bit higher over that window, but nonetheless positive returns, and it'll make, as you'll see in a minute, for some pretty good outcomes in terms of the pension plan's performance. I'll skip ahead here on the fixed income front. The other thing we're mindful of, we'll talk a little bit about this right when we get to the dollar cost averaging discussion. Rates have moved up a bit in the new calendar year. You see that here. Baseline comparison here, the beginning of the calendar year, and then kind of the changes, and they're fairly dramatic. They've since come back in a little bit, but fairly dramatic nonetheless. So we have had that upward pressure on rates. The front end of the yield curve has steepened a little bit. But certainly, right, in any broader historical context, in a vacuum, right, if you look at where rates are today, and I think the 10 years at about 1.6% this morning or thereabouts, still from a historical perspective, pretty darn low. And just something to be mindful of, right, in terms of return potential for fixed income on a go-forward basis, at least over the next couple of years. The appetite for risk and where there has been incremental return continues to be away from government markets and in things like investment grade and high yield. You see the well-behaved down here in the lower right-hand corner of the exhibit. Spreads, right, and that investor bid and appetite for yield continues to be pretty strong, and to the extent that there have been some incremental returns, that's where investors have been sourcing them from. And then finally, on the equity market front, really the only thing I would point out to the board here, I know we've talked about it a little bit, we've had a pretty stupendous run, right, in equity returns, as we just talked about and saw. That has had some implications for sure, right, for valuations. So these are cyclically adjusted PE multiples in the U.S., overseas, in both the developed and the emerging arenas, and particularly in the U.S. Right, we've had very strong performance, and that does mean that we've got somewhat elevated valuations, certainly to a greater extent, at least with this one particular ratio, than the international counterparts. I don't think there's anything actionable here. The board has always been great, right, about keeping the diversification profile for equities, right? So you've got meaningful allocations across these three segments. It's certainly not a time to abandon equities, but just be mindful, right, that we have, by virtue of what's happened over the last year, dragged some of those forecasted returns into the current time frame. You'll remember when we convened our last meeting, we looked at some of the asset allocation detail, and it did pull that return in a little bit, if you will, just being, our statistics reflecting the fact that we have had a pretty good run. So again, nothing to act on, but just be mindful of. So that is a quick cycle through the markets and the economy. Anything from the board that needs further clarification or detail before we shift over to the portfolio? Look at some numbers. I don't see anything. It looks like folks are okay, so we'll forge ahead here. So here's the exhibit before you. You've got the portfolio as of March 31st. So Peter did make reference, right, and mention of the absolute size of the trust and the good performance. So about $265 million of invested assets at the end of March. Per the edict from the board, as you know, a short while back, we did rebalance the portfolio back to targets, and you see pretty darn close to those targets today. A little bit of interim fluctuation by virtue of market movement, but nothing all that dramatic. So I think the allocation footprint remains aligned with the target weights that you've set, and moreover, I think we're in pretty good working order. The entire roster is probably as good a place as any, just to reaffirm for the board, has the maintained designation from our research team. So if you remember, they do their formal quarterly due diligence, run through all of the strategies and make sure that they continue to have all the attributes that attracted you to them in the first place. And I think we're in good working order across the roster. and no action items to contemplate at that level. And moreover, really just stupendous here, I'd turn your attention to the middle of the exhibit here. So you see a decent first quarter for the plan, calendar quarter, 4.1% net of fees. And you see the benchmark was up a little north of 2.5. And then really just an absolute number, right? That I don't honestly, having been in the business for 30 years, remember reporting a 12-month number like this, but the plan was up 42% for the 1-year period ending in March. And you can see there good contribution from managers really across the entirety of the program, which is encouraging. And the broad markets were up a little less than 36%. So certainly, I think from a performance perspective, by rights, right, really everything we could have hoped for and expected. A pretty amazing year, all things considered. With that, let me pause again. I know I want to keep us kind of a pace here with the collateral and all the information. We've got a couple of other topics, but anything from the board on allocation or performance that merits more discussion or highlight?
I've got a question, Chris.
Sure.
Lazaro Guzman, member of the board. On page 17, in the fixed income component, we've got a target of 17% for the Vanguard Total Bond Market Index, and then 13% for MetWest. Either on this page or as you go through the performance, can you talk about kind of your thoughts around indexing in the fixed income space? Managers' ability to sort of outperform the index net of fees, what your thoughts are there. And then, either, I'm not sure if that breakdown is consistent with something you recommended, or maybe that's, from kind of how we thought about things years ago. But as we think about, the additional dollars that we're going to have to invest, maybe put it into that context, is that consistent with how you would invest the total portfolio once the new dollars come in, sort of in the June timeframe?
Great question, Lazaro. And I think we'll stay right on this page for the time being, and I'll answer the question a couple of different ways. There was a few data points and perspectives, and then we can flesh it out. I think that in an environment like perhaps that we're poised to continue to have, right, where interest rates may grind a bit higher here as the economy continues to repair, that is historically that has been an opportune time for active managers, right, versus the index. So the construct that we've got here, to answer your question more directly, I think is a direct byproduct of the board's kind of preference through time, just in terms of trying to mix and match a little bit elements of both. As I sit here and look at this morning, and I think the way you frame it is perfect, right? Because I think there is implications for when you begin to fold in those other monies in the summer timeframe. I think there would be an opportunity, Lazaro, for more active management here versus the index. And in fact, given the dollar sizes, it'll probably be a natural point in time for us to look at a complement to MetWest, right? We're going to have a lot more monies coming to fixed income. So I could envision us having a second, for example, active manager alongside MetWest. It gets a little more convoluted in terms of the actual constituent and attributes of the managers and the mandates, right? Because one of the things, I think we've talked about it with the board in the past, there hasn't been appetite for it just yet anyways, is these so-called unconstrained mandates, right? Managers that have bigger toolboxes and broader footprints that can kind of work across the fixed income spectrum, with a particular focus, for example, on interest rate sensitivity and duration profile, and take active steps against that should rates continue to go higher. MetWest certainly does that on the margin, but there are managers that can do that in a much more dramatic fashion. And we have seen many of your peers, in anticipation, again, of those higher rates, starting to reconfigure their fixed income mixes, if you will, and not abandoning indexing, right? Because you do get, from a cost economy perspective, some fairly attractive, outcomes, if you will, in terms of the makeup of the portfolio and its fees, but perhaps a reconfigured mix that does step a little bit more into active management. So I would, that's a lot, right, for the board maybe to consider right now. Maybe I'd defer back to you and then ultimately to the chair. I think in that meeting that's potentially scheduled for the summer timeframe, that would be a topic for us to come back more explicitly with some ideas around what that may look like. I don't know if that helps or not, Lazaro.
No, it does, and maybe I guess what I'm trying to get to is for that meeting. If everybody's in agreement, if we could have sort of a recommendation, because I think shortly thereafter we're going to be getting the proceeds to invest. So maybe you can have a recommendation. I don't know if a motion needs to be put forward, sort of, what do you think is the right split, active versus passive, in our fixed income portion of the portfolio? And then if you could have some managers that you would be recommending in terms of, what's, given the interest rate environment, given the higher dollar amounts that we have to invest, sort of what's your best thinking in terms of how to move forward?
This is Nancy speaking. I think that you've laid out a good approach for Chris to come back to us with. So I don't think that we need to have a motion to vote on to give him that direction. He's only going to be providing guidance, but we certainly would be looking to, in that time frame, that's when we would do the motion to accept his guidance, I think. Peter, does that sound like the right steps? Make sure I'm doing it right.
Yes, that sounds perfect.
Okay.
Yeah, well, it's a great course of action for us as well. So I think it makes perfect sense as suggested. We'll come back with all those details for the board.
Yeah, and Chris, if you could have, you talked about unconstrained, and then maybe just, a couple of core plus managers, just to kind of look at some of the differences.
Absolutely.
It's Pete Privatera. Just as long as we agree that to finalize any decisions at that meeting.
Right. That's why I think we, am I still on mute? I think that we want to be very cognizant that meeting happen, and that we do have some thought process, maybe even ahead of time. Chris, there might be an opportunity for you to send out some material ahead for folks to really process. You always do, but I'm just thinking maybe even a little bit more ahead than normal. We can work on that.
Absolutely.
Okay, thank you.
Those are good, great suggestions, and they make perfect sense. Anything else from the board on allocation or the other thing we'll do alongside that, I should say here, I guess it's as good a place as any, right? A similar, Lazaro, to your point on fixed income, within some of the equity categories as well, right? Given the magnitude of dollar amounts, we may want to have to broaden out the roster a bit. And add a couple managers selectively just to accommodate those larger dollar amounts. Particularly, right, in areas, think about small cap in the US, right, where there can be capacity constraints for managers. And something we'll bring to the exercise too, if nobody objects, just to give you a little perspective there. And we'll map that all out in greater detail, of course. Okay. Well, that's
important.
Let's bear with me here. Let's shift gears. I should have bookmarked this, but I didn't. Bear with me for 2 seconds, and we'll shift gears to peer, because we did want to just catch the on this, and I'm going to try to expand this a little bit. Bear with me here. We'll pick and choose numbers. I know the exhibit's busy, but just to step back for a moment. So as mentioned earlier in the discussion, peer is a manager that does have an incentive fee. This structure, honestly, I think predates all of our involvement with the board and goes back for years and years and years. You can see it goes back literally 20 years. And Pier got its starts in Europe. And in Europe, fees, even for incentive fees, even for public equities, are fairly common. So Pier naturally offered to its U.S. institutional investors two fee frameworks: a traditional flat fee, and then an incentive fee based on incremental performance over and above benchmark. And they cataloged that on a calendar year basis. So what we've done, we went back through time here, you can see on the exhibit, and we just wanted to draw comparisons between what those two fee construct would have meant to fees over those 20 years. And you can see here through time, there are many times when Pier earns an incentive fees, and then there are equally periods, right, where they do not, where their performance is not strong enough, and they do not receive that. So it's been a little bit of a mixed bag, but I would tell you honestly and frankly, right, that if you do the arithmetic here, you see down at the bottom of the exhibit, if you do that comparison over time, the flat fee construct that they use is 1%. It's the right-hand column. And then again, we arithmetically linked in your current structure. Your current structure is 40 basis points plus 20% of the outperformance over and above the benchmark when they achieve that type of result, again, which isn't all the time. You see over the 20-year life of your engagement with them that the incentive fee has been about $319,000 higher than the flat fee construct. Let me just bear with me for just a second here. I apologize. I should have done this first, but just keep that in mind. And let's just go back for a second so I can show you more explicitly. Pierre's been, again, one of the stronger performers in the program. We net that incentive fee through time. So it's been about $16,000 a year higher, right? If you take that 318 and space it out over 20 years. But right, it's been for the right reason, right? And that's because Pierre has outperformed. So my apologies. I'm not the strongest tech whiz here. I'm sure there's a quicker way to do this, but I did want to, you see right down at the bottom of the page here, I'd put your attention to this number here. If you can make it out, right? 20 years they've been in place. Here's Pierre's annualized number since inception, 12.4%. That does include the effect of the incentive fee through time. So they've kind of handily outperformed the index net of fee, and a very strong performer for the board. And they have, frankly, earned a bit in the way of higher fee, all things equal. I guess the motivation, working through the chair and Peter for the larger board really here was twofold. One is just to remind the group of that structure. And then moreover, here I would tell you is absolutely agnostic about which, structure the board's comfortable with. We've revisited this structure a couple of times, over the last several years. Now, I don't think with this particular group, but with some of your predecessor committees, and they've always defaulted to being comfortable with the incentive structure, knowing that points in time it will generate big incremental fees due Pierre. So we wanted to just come full circle on this, share with you the longer perspective and what it's meant economically. Again, Pierre's been a very strong performer. By virtue of that strong performance, they have earned a bit in the way of incentive fee. If the board says, you know what, we don't like that incentive fee anymore, Pierre is absolutely, whatever you tell them, if you want to convert the arrangement to a flat fee, more typical what you see elsewhere in the portfolio and in your lineup, they're happy to do that. So really, we just wanted to, every couple of years this seems to come up, and we want to be certain that people understand its construct and get people's kind of input on it and what you may want to do, if anything, differently going forward.
Right. And this is Nancy speaking. Yeah. Chris, thank you. This is Nancy Dean speaking, Chair. Being the longest tenured person on the board here, I think I can say that this typically comes up whenever there is a significant up performance relative to the market provided to us by peer, but which then of course means an additional fee. And you can see that as Chris said, it kind of comes up. The last time that we did discuss this, it was back in 19. So some of us who are still currently on the board were active members of the board at that time. And so we did have a payment to make in 19 based on their 2018 performance. One thing I wanted to ask Chris, I think you might have said it, but I'm not sure since I sort of understand this a little bit more for all the time that I've looked at and sort of struggled with this mentally. But I believe if they haven't, they don't get paid even if they have a strong year until they have earned back what underperformance they may have had in prior periods. Is that right?
Yeah, there is a high watermark, and so they do have to earn that, recoup that back before it starts to kick in again.
Right. Okay. So as Chris said, I think it's always a good not just to step back if we have to pay based on performance. The good news is it's sort of a high class problem because they did have phenomenal performance last year. But I do think since it is a little bit different from the rest of the portfolio and our fee construct, that I would like to entertain either an affirmation, some additional discussion, but I would like for the minutes to show either an affirmation to stay with this current fee structure or to go the route that Chris said that peer is amenable to, which would be to migrate to a fixed fee. So I'll open that up for discussion. I know, Alan, earlier in the meeting, you had asked a question about peer and the calculation, and I asked to wait till we got to it on the agenda. So is there anything that you'd like to raise at this point?
Yeah, this is Al Lebo, member of the pension board. I just state that, you know, my own opinion on this is that incentive fees like this, in my mind, if anything, encourage the manager to take risks. Obviously, over the last 10 years or so, risks have paid off, and so that ends up looking good. But I don't think it looks as good when risks don't pay off. So my preference would be not to continue this structure and to move to the flat fee structure.
I can't see everyone, so I'm just going to ask if anyone else has anything to add to that or.
Nancy, it's Pete Privatera,
Yeah.
Finance Director and Board Member. But just a quick question. Chris, didn't you just state a few minutes ago that we might be looking for another active manager?
Yeah, I do think, Peter, that segment of the portfolio, right, active small cap will be a likely place where we may have to broaden out the manager roster just a touch, right, to accommodate those much bigger dollar amounts.
Okay.
Yes.
Would we be looking at, would we be looking at a similar type of arrangement or?
Likely not, Peter. Again, so as Alan intimates, right, it's for U.S.-based managers, incentive fees and long-only mandates like this, right, just a manager buying and building a portfolio of publicly traded equities, that construct is not very common. It is more so in Europe. And again, just kind of thinking through where our research team's head is right now, I think the candidates that we would likely bring you would be U.S.-based institutional managers that would have more traditional flat fee arrangements. I think is what you'll see.
Okay. And you did say that over the last 20 years, this type of arrangement has outperformed just a regular flat fee arrangement.
Well, the managers, right? The manager is wildly formed its benchmark net of fees. So that's why you're right. You have kind of the pickup, if you will, in the expense versus the flat fee.
Yeah. Okay. Yeah. And I just want to echo what the chair said, that I think we're talking about this now because of the actual fee itself, which was considerable. You know, it kind of reminds me that commercial I see all the time on TV. You know, we do better when you do better. But I don't know if that works. I would defer to, the investment people on this, but it seems that, if we've done well over the last 20 years, then I'm not sure if I would want to change it, but I would love to hear any additional comments on it. Thank you.
Chris, can I ask a question?
Yes, Les.
Absolutely, yeah.
So Lazaro Guzman, member of the board. You said that the fee was 20% of the outperformance relative to the index. Is that true?
Yes, correct.
So just maybe correct me if I'm wrong, but just kind of the way that I'm thinking about it is we're paying 40 basis points. The peer group average is 1%. So sort of our break even point is if they outperform the index by 3 percentage points over time, we that's sort of our break even. If they don't outperform by 3% over time, I think we make out better. And if they beat their index over time by more than 3%, we're going to pay a little bit. Is that kind of how we should think about it?
That's exactly right, Lazaro. You're spot on with that, right? Just for everyone's clarity, right? So I think Lazaro's suggesting, right? So 60 basis points, a fifth of it, right? So times 5 gets you the 300 that's made reference to. Right. So you're absolutely spot on with that. And they've been at 12.4 versus 8.7, right? Since the life of their engagement, which is like put us exactly where you're indicating. So yep, your analysis is perfect.
Okay. Thanks.
And really, again, I wish we could give you from our perspective a definitive recommendation. I'm not sure that there is one. It's almost kind of like akin to the active versus indexing discussion more broadly, right? In some ways, it just comes down to the philosophical bent of the board and what you're comfortable with. So I would just leave you again with it is in fairness an unusual arrangement for U.S. equity investing. Not unprecedented, but unusual. But peer will, again, accommodate whatever you like. They are absolutely indifferent to the fee structure, whatever the board is most comfortable with. They're happy to run the engagement in either framework.
Maybe to not to spend a ton of time on this, but I think Alan brought up a good point just in terms of sometimes managers are incented to take more risk. Maybe at some point through your analysis, if you could quickly, I don't know if you've got risk statistics for peer versus either the peer group or versus the index real quick. Just, I suspect maybe they've taken a little bit more risk. I mean, they've had a lot of outperformance, but maybe you could put that into perspective real quick for us.
Yeah, let me, you know what, I don't remember how we capture Lazaro. Bear with me here. I think they have taken a bit more.
This is Nancy. While Chris is scrolling through to find that, I guess I would say, or my observation would be, if they are who they are, so they're not going to take more risk with our portfolio, with this particular portfolio, whether they're on an incentive fee basis calculation or a flat fee basis. So I think it's important to recognize that yes, when sometimes people are on that incentive fee basis or managers are, that they may have a higher risk profile, but I'm not quite sure that we either like them as a manager or not at this point, I would think. I mean, that's my perspective. But Chris, you brought it up here on the screen for us.
Yeah, and I everyone can see this hopefully, and maybe just visually it'll appeal to folks. You see the 3 and the 5 year risk return plots for the manager on the top of the page. So peer, of course, is identified as the blue box, and then the Russell 2000 Growth Index, their reference benchmark is the gold circle, if you will. There, I don't see the actual stats portrayed, but to Lazaro's point, there you can see it across the horizontal axis, right, that they have taken a touch more risk in terms of standard deviation than the benchmark. Everyone see that, right? They're kind of a touch right on this scale in both time frames, but have generated substantially more return. So I think the answer to the question posed, right, is they have been a touch riskier than the benchmark anyways. I don't have that ready statistic across the peer group, but I think they are a touch more volatile than, if you will, kind of the segment of the market they're investing in, if that makes sense to folks.
Yeah, no,
What I
that's
would
helpful, Chris. I'm all set. That's not a whole lot more risk than the benchmark. So thank you.
Yeah,
Okay.
I think so too, but maybe if you want to give it any additional thought, that would be something when we come back with the your recommendation for the new money, that would be something that you bring to our attention. So at that point, if you want to pull together any more statistics than that. In
Yeah,
the interest of
we
time,
can do
though,
that.
what I do want to bring this issue to closure because it does come up every couple of years, and Alan has I think I'm the one that's in a position to make a motion because of our virtual format. So I will make a motion now that we migrate our fee arrangement with peer to the flat fee arrangement, away from our current incentive based. So with that, I would open up for any discussion or questions before we take a vote.
Nancy, can you repeat the motion?
Sure. The motion is that effective, and I would have to defer to Chris to see when we would make this effective, but that we would change our current fee arrangement with Peer Capital, small cap growth portfolio manager, from the incentive-based fee that we currently have to a flat fee of 1%. Chris, I don't know if we have to can we make that retroactive for January 1, or do we do it going forward?
We'll check, Madam Chair, with the manager, right? I think what we're going to have to do is we'll have to settle up, right, the reporting period we're in, right,
Do it like
the 2021.
July 1 or okay.
And so we'll get you that detail, but that's what I'm thinking, something like that.
Okay. Any questions or discussion, or do we want to wait until Chris has that answer for when we could switch that over before we take the vote?
If I could just add a point, it's small cap. It's going to be risky. I'm fine with them the way they are. I sort of like the idea they're paid for performance as opposed to being left if they don't perform.
Okay.
For whatever that's worth.
Okay.
You can go on.
Thank you. I've made a motion, so I think we need to take a vote. Lori, would you please?
Sure. Peter,
No.
Brittany,
No.
Ethan,
No.
Al,
I,
Lazaro,
No.
and Nancy.
I made the motion, so I would vote to migrate yes, but it appears as though it will pass, that we will retain the fee construct as it is. Is that right?
Yes, 4
Okay.
no, 2 yes.
Okay. Very good. Thank you. And thank you, Chris. I know I'm the one that kind of got Chris to go back in time. We have looked at this in other periods of time for peer, because it's always is a more complex discussion when we take a look at it. So I thank you for the extra effort to pull this together for us. And I think it may be wise to once a year, when we get that kind of settling up bill from peer going forward, that this be part of maybe the January or February meeting to take a look at that. Good. Okay.
if I,
Alan, I'm sorry, I can't see anyone for some reason on my screen. So if I'm missing anyone, Alan, did you have something to say?
yeah, Al Lebo, board member. Chris, I would just ask that in the future, if it's possible to footnote or somehow make it clear whenever you're presenting peer and its fees, that the true fee that we're paying is more like 1.3% rather than the 0.4 that we saw in the earlier presentation. Thanks.
This is
Yep,
Nancy.
we'll,
I think, Alan, on that chart, it does footnote that peer
Yeah.
has an incentive-based component to it, and it would not be appropriate. There's no way to project accurately what the fee would be without knowing the performance.
Well, you could say historically we've paid 1.3.
I'm not sure that that's an appropriate comment, Alan. To memorialize in a document, I think it does disclose that there's an incentive fee basis there. So, right, it's in the very tiny print. I can't read it from here.
Yeah, it is.
I could read it on my hard copy. So, it's 8:45. I think, Alan, you told me you needed to leave at 9. We still have a fair amount of the agenda to go through. And I think, Chris, did you want to circle back now to the bond proceeds?
Well, I was going to mention, Madam Chair, in the interest of time, knowing you have other things to tackle, to me, I would suggest to the board, if there's no objection here, we've provided for you again the information that relates to the different things we may want to do with the dollar cost averaging proceeds as they await their final home in the invested trust, if you will. So you'll remember we've cataloged short, ultra short and short-term strategies, and then at the direction of the board, some intermediate strategies as well, just in terms of what ultimately you want that to look like. As again, we set up formally the dollar cost averaging program. If it pleases the board, I think what might it make sense to do is this would be an obvious and natural discussion for your meeting that you're contemplating end of June, early July. And moreover here, we could provide some more updated data. Again, the takeaway, I think, as everyone knows, is there an appetite from the board to trade a little bit of interest rate or duration risk for a slightly higher yield is basically the story being told here. And it could be some combination of the two, right? Just to try to find that sweet spot that you're comfortable with. So, I don't know that there's, the desire or the time this morning to make a definitive decision on this. But again, if it pleases the board, I think we could update this material and, like you suggested, well in advance of our next meeting, have it out in an updated fashion, and then have a concrete conversation around what the board wants to settle on for the type of fixed income strategies that'll populate the dollar cost averaging pool.
This is Nancy. Any comments to that? Are you all willing to have another meeting that we will have to have closure on? It will need to be a single purpose meeting just on this allocation. I am somewhat reluctant to keep pushing this topic off, but have lots of other issues to deal with. So is there anyone who would not be available to have an additional meeting that isn't on the calendar?
So this is Ethan Goldman, a member. I'm fine having a meeting, but I would request that if we're going to take risks, we try to, one of the things I've asked for before and is sort of say where the plan is of where you're going to be. So if you're going to take a risk, how much is it worth? Frankly, I'm not that much into the risk, but I'd like to know the trade-off, the cost benefit. So for whatever that's worth. Thank you.
Thank you, Ethan. This is Nancy speaking. Anyone else have any comments at this point, or shall we just, we will ask Chris, and this puts the burden on you, and maybe you and I can coordinate some materials to get out to the board in the intervening weeks. All right. We'll do that.
Yeah.
Okay.
And I think the other dynamic, Madam Chair, probably here that's not reflected here that'll be important, as I mentioned earlier, right? The yield curve has steepened a bit
Yes.
over the last couple of months. So again, I'm thinking to Ethan's question, right? The dynamic around risk versus return may have changed a little bit, right? Where there may be a bit of a bigger lift or increment, if you will, for some of the intermediate strategies, just in terms of their yield profiles versus the short and ultra short, which I'm certain would be important information for the board to consider. So we can absolutely update this and get it out well in advance of that final meeting to set everything up once the proceeds are in.
Okay. All right. Then thank you very, very much. Rick, I will look to you. Now that we have the meeting scheduled to talk about, we will have to do some polling relative to when that next meeting will be. I think, Peter, is your preference for the end of June or very early July?
June, I would hope, because
Right.
we're going to close the first week of July. So
So just may I take a quick look across the board and think, and now I can see everybody. Is there anyone who is not going to be around at the end of June so that they would not be able to participate in this discussion? It's a very important discussion. No early vacations? Okay. All right. Thank you. Lori, you and I will put our heads together for some dates. Rick, anything else?
Nope, that's takes care of the June meeting. Good morning, everyone. Rick Ledwith, Executive Director of HR. And then we have our fall schedule lined up in the packet as well. First meeting September 13th, followed by October 18th and November 15th.
Okay.
That will round out the calendar year.
Okay, thank you. Brittany, any news from the town front?
No updates.
No updates. Okay, thank you. Then we do have our formal actions, but Rick, anything of particular concern or notice you want to highlight before we do our voting on these?
Good morning again, everyone. Rick Ledwith. Nothing, everything was fairly routine. So 10 new plan members, 8 non-vested terminations, 3 normal retirements, 1 disability retirement that the pension board approved at the last meeting. And then we have 1 vested termination and then 1 qualified domestic relations order that the board will vote on.
Okay.
Any questions?
No. All right. Then initially I will make a motion to approve the minutes of our virtual special meeting held on Monday, April 5th, 2020. And I would ask Lori to take the roll call to approve that motion, please.
If I could, this is Al Leba. I would actually like to end that if I can.
Alan, yes.
In the meeting minutes, I think it's 482. It talks about the percentage of scenarios that are favorable. I'd just like to add to the end of that in the wording here is Alan Lebo reiterated that the minimum scenarios assume a normal distribution of outcomes and a more realistic distribution would result in a much lower percentage. Just like that to be part of the minutes.
Alan, would you like to repeat that, or do you want to send that to me in an email so I get that verbatim?
Whichever way works for you.
Okay. Nancy, do you have a preference?
I think it would be better if Alan wrote it specifically
Okay.
the way he is proposing the verbiage. I would ask before we, does anyone have any question relative to incorporating that into the minutes? That clarification. Okay.
I just have a
Then-
question.
Yes, Peter.
I'm not, the way that this was presented, the percentage of positive outcomes was based on the analysis that was done by Milliman. So if Alan is doing if he's making a statement that based on his analysis, the percentage of positive outcomes is diminishing, then I just want to make sure that it clearly states it was his analysis. It has nothing to do with Milliman's analysis. I just don't want a conflict there. Thank you.
I appreciate that distinction, and I think that is why I wanted to make sure that we had the wording exactly as Alan put forth. This is a committee, not just one person who works on this. So we do want to make sure that it's representative of all the discussions. This was, so it is an important distinction to make. What if we, if we do not approve the minutes this time, if we approve them at our subsequent meeting, is that all right, Lori, or do these have to go someplace?
Sure, these could be, we could postpone it.
Then let's postpone it. Let's incorporate the language that Alan is proposing, and we will all view this insertion with Pete's caveat, because it is very, very important since these minutes get looked at by lots of people. Thank you. Ethan, did you want to say something?
Okay. I'm good.
Okay. Okay. All right, then, Alan, if you would be so kind to do that, and then we will tackle this at the next meeting. Then we do need I need to make a motion to approve the pension administration that Rick gave us the summary, high-level summary for. You have had all the detail in your package. So with that, I would ask Lori to do the roll call for the pension administration approval.
All right. Peter,
Yes.
Brittany,
Yes.
Ethan,
Approved.
Al,
Yes.
Lazaro,
Yes.
and Nancy.
Yes.
Okay, motion passes.
Thank you. We do have invoices for consideration. If this is, these are invoices from Reed and Riga. I would make a motion to approve these items. And I would also include with that, in the interest of time, that the motion expand for both the Wells Fargo custody fee invoice and for the Pier capital invoice, since we've already talked about that earlier this meeting. So the motion will be for the Reed and Rieger pension administration and for the investment management fees. Lori?
Okay, sure. Peter,
Yes.
Brittany,
Yes.
Ethan,
Yes.
Alan,
Yes.
Lazaro,
Yes.
and Nancy.
Yes.
Motion passes.
Okay, thank you. Any new business? Anyone have any other issues that they would like to bring up this morning? Leon, thank you for attending with us. We don't always have special guests. Thank you. With that, then I will thank everybody. We do have another meeting to get on the calendar. I seem to always not want to do that to your calendars, but I wind up doing that. This is a very, very important year for us on this board relative to all the work that's been done for the pension obligation bond. So I thank you for that. Thank you, Chris. And I will make the motion to adjourn. So there we go. Thank you.
Thank you.
Thank you.